The International Monetary Fund, or IMF, has released a new report on how deglobalization could set back the global economy. The institution warning in its report that increasing tensions between the U.S. and China could cost the world 2% of its GDP. For more on the IMF's warning, let's go to Yahoo Finance's senior columnist, Rick Newman. And Rick, your take on this, the latest.
They're pushing back against this whole, it's not really a concept, it's actually happening. The reality of deglobalization, which they call slowbalization, in quote marks. It's this idea that the United States and other countries, Europe, they're trying to spur more domestic production. We've seen this in the Biden administration in things such as the CHIPS Act from last year and other policies. And there's clearly growing tensions between the United States, partly over military and national security concerns. So what the IMF is saying is this will actually produce inefficiencies that will cost the global economy some level of growth. They're actually saying this will hurt emerging markets more than it will hurt developed economies such as the United States. But nonetheless, this is sort of an economic way of looking at deglobalization and saying, look, there are some costs to this. Even though it might be politically popular, there are some costs. Now, I would point out that this whole notion of decoupling between the United States and China is a little bit overstated. We still have massive amounts of trade with China, and much of the stuff Americans buy on Amazon or at Walmart still comes from China. So those goods are still flowing in. But look, we've seen a series of things here. The Trump tariffs on Chinese imports from 2018 and 2019, more subsidies for domestic production here in the United States, trying to bring some supply chains back to the United States, especially after COVID. And then new export controls from the Biden administration on high-tech sales of U.S. technology to China, all pushing against globalization. So there will be some cost to this.
And Rick, the part of the deglobalization means in part an end to cheap energy for certain consumers of energy, notably in Europe. U.S. basically energy independent, net. But over in Europe, with the war in Ukraine, that sparked new concerns about their energy independence, and they're paying through the nose with heavily subsidized government rates still. This kind of changes the input costs and the supply and demand dynamics for their exports. And just wondering how energy really fits into this whole theme of deglobalization that you're talking about.
Giant changes in energy flows during the last year and a half. A lot of that comes from the Russia's invasion of Ukraine and the cutoff of Russian energy supplies to Europe, but many other things also going on, Jared. I mean, the Saudis and other Middle East nations now are turning more toward China as their main customer rather than the United States, because the United States is producing so much more energy than it did 10 or 15 years ago, and China needs it. So, actually, I'm not sure we have deglobalization of energy because so many countries need energy from new sources. I mean, one of the biggest developments in Europe in the last year has been trying to find new sources of energy. Some of that has come from the United States. Some of it has come from the Middle East. Some of it has come from Australia. Some of it has come from Europe itself, such as Norway. And this is going to continue. So we have seen a remaking of global energy flows during the last year. And I think most energy analysts think that is going to continue.
Yahoo Finance's own senior columnist, Rick Newman. Rick, thanks so much. We appreciate it.
Bye, guys.